Hey guys, so I want to introduce you to a new strategy that I've been playing on for the last few years, and it's generally worked out quite well. So I'm a Dubai-based personal trainer, but I've been trading for about 10 years or so, doing a bit of day trading, swing trading, and also general investing. So I know a lot about the stock market, about ETFs. So I'm going to be investing around $20,000 per month. So you'll be able to see like how my trades go, what I do, and I'm probably soon going to open up a Telegram as well, so you can follow through. So my strategy is all about swing trading. Swing trading is when you look for an oversold stock or ETF, an ETF is a collection of stocks, and rather than kind of buying things at the top, like S&P 500, which has rallied quite a lot, I look for things that have oversold or sold off for a while, and then I buy them, wait for it to go up, and then sell it again at about a 10-15% profit. So for example, one of them is the health sector ETF. The reason why this is a really good ETF, as you can see, it's always in an uptrend. And the reason for that is because obviously it's a defensive sector, meaning we always need healthcare. This ETF specifically, it holds companies like Lilly, Johnson Johnson, United Health Group, which recently had a massive sell-off as well. So this was actually what also triggered me to buy it, because I was thinking once this starts to go up and rebound, alongside some of the other names, this whole ETF is also going to rebound as well. And you can see that typically before, it normally kind of sells off a maximum of about 5 to 10%. You can see in the past it went down here about 13.52, and then it's always bounced up about 10% or more. Then you can see here again, it bounced down around 8-9% or so, and then it always has bounced back up. But I always look for ETFs that are uptrending. So I never buy anything that's kind of staying the same. Is always something that I know is going to generally go up. And also the benefit of buying ETFs is that you're buying a collection of stocks that are the top of the game in that sector. So this ETF, for example, holds, and also they rebalance every 6 months. So what happens is every 6 months, the fund manager will change the stocks that's in the ETF to make sure that it only holds the best stocks of that sector. So it's a really, really safe play. I prefer it much to buying oversold stocks, because one of my experiences that I had before, which put me off trading stocks so heavily, was when Meta sold off in 2021. I remember I kind of around here when it sold off around 40%. I was like, okay, this is an amazing buy. I'm going to shove loads of money in there. I'm sure it's going to go up at that point. I put in about 10,000. I leveraged it by 5, which is a mistake. And I was like, okay, this is definitely going to go up. A week later, it went up a little bit, and I made like, it was up about $3,000. But then I didn't sell, thinking, okay, this is going to rally up because it's a great company. And then it crashed even more, another, as you can see, 59%. And so what I learned is never to trade oversold stocks, because with stocks is that you just never know what's going to happen with them. Whereas with ETFs, you know that generally speaking, they're only going to sell off maybe 10 or 15%, or in a massive crisis like COVID, it was about 20% or so. Here we go, it was about 15% as well. And even here, you can see there was like a little bit of a sell-off, and it was about 13-14%. So generally speaking, they're really, really safe trades. It's such an easy play. You know that it's going to go up because it's always uptrending. You always need healthcare, 10-15%. And right now, this stock has come down 15%. So I know I can pretty much play for certain. This is not financial advice, by the way. I'm not just a personal trainer who's like playing around with the stock market. But you can see from that trend, like self even, that when it sells off like this, it generally always goes up again. So what I'm doing is I'm doing a strategy called ETF trapping. So it's something that I came up with myself. And essentially what it is I trap the ETF into squeezing out profit. So what I do here, for example, is I put in a bit of money. So you can see that I put in 22K into the XLV, which was that one, and $10,000 into the global healthcare iShares ETF. Quite similar. This one at the top has got a global, so it's got companies from Europe, and other parts of the world. It's a little bit different. So they both have sold off quite well, so I'm bailing to both of them. And we know, so research from ChatGPT is quite clear that it will rebound, generally speaking, around 10-15%. Essentially what I'm going to do now is wait for it to rebound. Also at the same time, you'll get paid about a 1.8% dividend yield. So not only are you kind of paid as it rebounds, but also you will get a dividend yield of about 1.8%. So the total return in about 6 to 9 months should be around 15 to 20%. Now, for me, I prefer that strategy rather than buying something like S&P 500. And the reason for that is because when you're buying the S&P 500 right now, and many of the times, you are essentially buying it at the top. So it has a big room to drop. Whereas when you're buying something that's already dropped, how it can go down, it can't really go down much more. So you are a lot safer. And for me, I want to make sure that I make money in the safest way. And S&P 500 can always drop like 10-15% as you saw recently with the Trump crashes. Whereas let's say rather than buying at the top there, if you had bought here, which I did also, you have that rebound play. And also bearing in mind, when something drops like 15%, let's say it drops from here to here, when it climbs back up, it climbs back up a higher percentage. So here it was 4662, it dropped down here 21%. But to get back up to that level, it actually has to climb a few percent more. So you can see it climbed about 26% to get back to that similar level. So you essentially make a lot of money on the climb up, more so than just buying at the top. My strategy is to buy the stock or the ETF, and then let's say, for example, I put in $10,000 or $15,000, and then if it drops another 5%, I buy a bit more. And the thing is, with ETFs, you know that they're only going to drop, especially something like this, max 15, in very, very rare cases, 20%. So if you're buying at the 15% target drop, then you know, okay, it might drop a few percent more, but it's very unlikely to drop from here. But if it does drop further, I generally put in a bit more money, so in like $15,000 more. And essentially what will happen is it will bring down my average price. And then when it eventually starts to go up, I'll have a much bigger profit. But by doing this, you're essentially trapping the ETF into giving you profit because you know that it will rebound. And the lower you keep buying, the more rebound profit you're going to get as well. So there's a few ETFs that I'm trading at the moment for a swing trade. So generally I'll hold them for about 4 to 8 months. I'm looking for about a 15% profit, and I'll be maybe investing that money into another ETF. If you want to know more, I'm going to make an Instagram channel, a Telegram channel that you guys can follow because this is something that I've been wanting to do for a long time, and I'm just out now starting my YouTube channel. So yeah, if you find this really interesting, comment below and let me know if you'd like me to make an Instagram and a Telegram.